Mr. President. Just caught me there thinking there was more time. Senator Smith, I know how passionate and supportive he is of these particular changes. He was able to sum those up very concisely. But I also am passionate and supportive of these changes to our tax and superannuation laws, particularly laws to facilitate scrip-for-scrip rollover and assist firms that would like to merge, and that's a very important part of our economy to assist those aspects, and also to help protect people with low balances in their superannuation accounts. Two relatively small changes to our overall tax system, but important ones nonetheless, because the coalition government is committed to fairness and sustainability in our tax and superannuation systems. We announced that we would deal with a backlog of tax measures when coming to government. Some of the decisions in this bill deal with decisions that were actually made by the previous Labor government and were largely uncontroversial and ones that we were happy to support, but there was a very large backlog of measures that were there in our tax system that had not been dealt with when we came to government. So I applaud the government for bringing this forward and dealing with these issues. This bill, this particular tax and superannuation laws amendment bill, incorporates changes that are covered in three schedules. The first schedule removes unintended consequences in the tax system. Schedule 2 outlines protection for lost superannuation accounts with low balances, and Schedule 3 helps ensure that everyone pays the right and correct amount of tax. A large part of this bill ensures that our tax laws are robust and cannot be circumvented for an unfair personal or corporate gain. Of course, as situations change and new information comes to light, our tax system should change accordingly. These amendments undertake tax changes that make our tax system fairer and more robust, and they are important integrity measures that will eliminate unintended consequences. The overview of this bill incorporates three schedules, as I said. I'll just expand a bit further on each of those. Schedule 1 includes improving the integrity of the scrip-for-scrip rollover provisions, and these are provisions that tackle the tax treatment of equity transfers in a merger situation where two companies might merge. There will be a potential transfer of equity ownership between the parties involved in the merger rather than a cash transfer per se, and that of course makes it more difficult for the tax system to deal with those transfers. But these laws, we have laws to deal with scrip-for-scrip rollover issues at the moment, and these laws will help improve the integrity of those processes in a merger situation. Schedule 1 amends the scrip-for-scrip rollover rules to ensure they are better targeted and work as intended. The measure is an integrity measure which ensures that opportunities for entities to indefinitely defer tax are removed. Scrip-for-scrip rollover rules provide tax relief for certain merger and acquisition transactions. They apply where share or interest in a company or trust are exchanged for similar shares or interests. The tax ordinarily payable at the time of the exchange is deferred until the new shares or interests are sold. This reduces the cost of takeovers and mergers, as the acquiring entity does not need to compensate the share or interest holders for tax that would be otherwise payable. The rollover ensures that tax is not an impediment to merger and acquisition activity taking place in Australia, and merger and acquisition activity is an important element of a functioning capital market, and a functioning capital market is extremely important for our economic growth and development. Integrity rules in the scrip-for-scrip rollover prevent entities accessing the tax relief in some circumstances, generally where both the acquiring entity and the entity being acquired are controlled by the same person or group. A recent court decision highlighted that these integrity rules were not operating as intended and that they were able to be circumvented. This was done by temporarily suppressing the ownership rights of related parties through a fresh issue of instruments. This measure in this bill strengthens these rules to ensure that entities cannot inappropriately access tax relief through this structure. These strengthened rules will help protect integrity and apply to both companies and trusts. Further, the measure also changes the treatment of some acquisitions, so-called downstream acquisitions, which involve the use of debt to reduce an amount of tax payable. These amendments are required to ensure that the rollover cannot be inappropriately accessed, to overcome issues with the use of debt in some transactions, and to ensure that the rules apply to both company and trust restructures. These amendments are narrowly targeted and will impact only those merger and acquisition transactions which inappropriately access rollover relief. As a result, they are not expected to make restructures more difficult in Australia. An advisement from the Corporate and International Tax Division the Corporate International Tax Division have advised, of Treasury that is, have advised that this measure is not expected to impact small businesses at all. There is an unquantifiable, potentially large revenue protection associated with these amendments. Obviously, that protection will depend on the mergers that it does impact, and they would be, I presume, very difficult to estimate because merger and acquisition activity does go up and down considerably and varies from year to year depending on the economic climate. But it's important to make sure that we do keep integrity of our tax system and build confidence that our tax system applies equally to everybody in our economy, companies, households, businesses that are merging alike, and this small measure will help to improve that integrity. Moving on to Schedule 2 though, of the bill. Schedule 2 is an amendment to incorporate the exemption of income earned in overseas employment. Schedule 2 will apply to those who are an Australian resident for income tax purposes while overseas. The measure removes an income tax exemption that is currently being accessed by Australian government employees who are posted overseas for more than 90 days to deliver official development assistance. The intent of this income tax exemption is to provide relief from double taxation, but no longer has this effect. Instead, it now acts to provide as a tax break for many Australians who are not liable to pay income tax on their foreign earnings in Australia or in the overseas country. In the 2009-10 budget, the former Labor government tightened the eligibility for this income tax exemption, or I should say announced that tightening, and this measure will go one step further by ensuring that all government employees who deliver official development assistance overseas are subject to Australian income tax on their pay and allowances. The change will take effect from the 1st of July next year. This change will not affect the taxation arrangements for private sector aid workers or charity workers, and it will not affect the Australian Defence Force and the Australian Federal Police. These groups will maintain their existing eligibility for an income tax exemption on income earned while working overseas. This particular measure was announced in last year's budget, and it will result, or is expected to result, in a gain to revenue of $6.7 million over the forward estimates. Mr. President, we are lucky to have a tax system which generally works and a personal income tax system which applies in a progressive and I think overall fair way to most Australians. This income and tax exemption was introduced for a valid reason, to ensure that people who were working overseas were not taxed in the country that they were working, as well as in the country of their residence being Australia. But over time, it has been highlighted that this tax exemption has become more of a tax break for certain Australians who travel overseas to work, and it has particularly meant that government employees who claim this exemption have not been liable to pay income tax either in Australia or overseas. The practical effect is that some government employees are eligible for an income tax exemption on foreign earnings, while others are liable to pay income tax. This bill will ensure that all government employees who deliver official development assistance are subject to Australian income tax on their pay and their allowances. The amendment will take effect from the 1st of July next year, and will standardise the tax treatment for government employees across the sector. And in the context of in the past year of some controversy about the fairness of our tax system, largely involving large corporations, it's still important that we maintain the integrity of the system across individuals as well, that we all pay our fair share of tax, and this is a reasonable change that I hope will be supported. Moving to Schedule 3 of the bill, which deals with small balances in superannuation accounts. I think it's important to first, though, put some facts about superannuation and particularly superannuation that is lost or in small balances that may be classified as lost on the table. Under the current arrangements, a super fund will not be considered lost, even if it has a small balance, if an individual holding that account has confirmed their current address within the previous 2 years of membership, has taken a positive action such as deferring a benefit in the fund, or they have contacted their superannuation provider and indicated that they wish to continue to become a member. The unclaimed super rules do not apply to amounts above the threshold or to the self-managed super funds or defined benefit funds. Superannuation is important to all Australians. We're all benefits of the fact that we live longer, and we probably can expect, given current actuarial tables, that if we do make it to the ripe old age of 65, we'd probably have at least another 20 years on this planet. So people do need to plan for that eventuality, and our superannuation system helps them do that. We do not, of course, have a crystal ball about what may happen in the future, but we need to have superannuation policies that do allow people to retire and have some money to support themselves and not rely simply on a government pension. Most super funds have put together a retirement standard which one could calculate how much you would need to live off in retirement, take into account the usual expenses for a retiree who owns their own home. That is why the coalition government has introduced tax and superannuation laws to assist people increase their superannuation account balances and to make it more accountable. It is important that Australians keep track of their super. Many Australians who have changed their name, address or job have lost track of some of their super. Having several super accounts means they are not maximising their super and are reducing their overall superannuation investment by multiple fees and charges. If you are in this situation, you can use the Super Seeker search tool to find out the balances that you currently have and ensure they do not become lost. And this final schedule of the bill does deal with these lost superannuation account balances, which relate to small accounts, and if they are inactive for a certain period of time, will be transferred to the Australian Taxation Office. This particular measure was announced again by the former Labor government in the 2013-14 budget, the last budget of that government. However, they did not pass legislation for this measure. On the 6th of November 2013, not long after the new government was elected, we announced that we would enact this measure as part of a broader suite of measures that were previously declared but unlegislated through the parliament. Currently, the current law and situation is that lost member super accounts with less than $2,000 must be transferred from superannuation funds to the ATO as unclaimed superannuation money. This measure will increase the $2,000 threshold in two phases. First, to $4,000 from the 31st of December 2015, and then to $6,000 from the 31st of December 2016. Lost super is a super account held by a super fund where the fund has lost contact with a member or the account has been idle for more than 5 years. When people get into super, we know that about 70% of employees are members of the default fund offered by their employer. When many people switch jobs, they often end up with a new super account and fail to consolidate these existing accounts. As a result, many people end up with more superannuation accounts than they want or need. According to the ATO, 45% of working Australians have more than one superannuation account. In many cases, members are not even aware that they have lost super accounts. For super accounts with smaller balances, the cost of fees and charges and insurance premiums can exceed investment returns. This can be particularly problematic for lost super accounts because, in most cases, the members aren't aware that they have these accounts and can end up losing money that was meant for their retirement. Transferring lost super accounts with low balances to the ATO helps protect such accounts and preserves their value until they can be reunited with the member. The ATO does not charge any fees for maintaining these accounts. Individuals are able to reclaim their super money from the ATO at any time and are paid interest calculated in accordance with the Consumer Price Index when they reclaim this money. In the 2015-16 budget, the government announced 6 measures that will reduce red tape for superannuation funds by removing redundant reporting obligations and by streamlining some of the lost and unclaimed superannuation administrative arrangements. These include updating the definition of uncontactable to account for contemporary forms of member communication, for example, to include online communication, support for eligible rollover funds, proactively consolidating lost accounts and allowing direct payments of lost super accounts held by the ATO to persons with a terminal illness. These changes will make it easier for individuals to be reunited with their lost and unclaimed superannuation. The ATO has a range of strategies in place which aim to reunite members with lost and unclaimed superannuation accounts and reduce the number of unnecessary and inactive accounts in the superannuation system. Some of the strategies are matching superannuation accounts to an individual, providing this information on an online portal, and proactively working with super funds to ensure that they have updated addresses and contact details for lost members. The estimated fiscal impact of this measure is $483.9 million over the forward estimates. As a general rule, Australian residents are taxed in the Australian personal income tax on their worldwide income. This tax exemption was introduced to ensure that Australians— sorry, I've just skipped forward there a little bit, but these superannuation accounts are very important to make sure people are kept in contact with, and that's why this measure was announced, that we would continue it, and we would continue to improve transparency in our tax system. I'd also say that the issue of multiple superannuation accounts is one that the government has taken some action with since coming to government. We have made it easier for small businesses to have their superannuation forms consolidated and filled out by the Australian Taxation Office, not themselves. One of the issues with multiple superannuation accounts is sometimes small businesses suffer under large amounts of red tape when they need to allocate their component of superannuation payments to different accounts. Now they can apply to the ATO for the ATO to handle that amount of red tape, and they simply have to transfer the appropriate superannuation guarantee amounts to the tax office, and they'll handle it from there. I'd say I actually think that this can be built on in the future. I agree with Peter Strong from the Council of Small Businesses Australia that it is unusual and a little strange that each of us, when we usually start a job— my first job was at McDonald's, and you get put in a superannuation account. As I said, more than 70% of Australians just go with a default account. That's what I did at the time. And you end up with these little small super accounts all over the place, connected to different employer superannuation funds. It's strange. It's strange that a system that is meant to take into account my retirement and other Australians' retirement is so handled by the employer, not me, so that the superannuation account depends on the employer you work for, not who you are and what your individual savings plan for your retirement might be. So it seemed to me to make a lot of sense that when an individual starts work, they would perhaps be put in a default fund, not connected necessarily to an employer. There are now my super accounts and other small and basic superannuation accounts that could perhaps serve that purpose. And then the employee, I would decide whether I want to change from that account at any particular time. Just because I moved after a year— I wasn't very good at flipping burgers, so I didn't get the sack, but I left McDonald's and went and worked to a car wash. Well, why should my superannuation change just by doing that? Why should it change? It should only change if I make the decision to change it, and there's no reason why we couldn't have a system where you're in a default account at any particular time, and if you want to change, it's not about changing your job, it's about simply changing those details with the Australian Taxation Office. And we could build on that system we've introduced to ensure that businesses themselves would therefore not have to be interfaced with the superannuation system. They can get back to their job, which is about providing a service, producing a product, employing people, and all they need to worry about then is transferring the irrelevant superannuation amounts to the taxation office, who would then put them in the appropriate accounts according to what an individual wanted and needed. Thank you, Mr. President.